In our last video explaining rolled equity, we mentioned that the tax treatment can be favorable for the seller depending on the legal structure of the company and the transaction. While the tax treatment of rolled equity is dependent on the particular facts of the transaction, there are two general scenarios. Let's return to our previous example, where John rolled $2 million of his $20 million sale. In a taxable rollover scenario, John receives all $20 million of proceeds in cash, is taxed on the full gain now, and then reinvests $2 million back into the company. This scenario works like any other investment John would make with his proceeds and isn't particularly tax efficient. The tax-free rollover isn't actually tax-free, but may still be the seller's most tax-efficient option to reinvest a portion of his or her proceeds. In most cases, the seller can defer a taxable event on the rolled equity until a future liquidity event, rather than paying tax now. In our example, John isn't taxed on the $2 million of rolled equity at the time of sale. Instead, his taxable gain today is based on the $18 million that he receives in cash. Later, when he monetizes the $2 million investment, he will pay taxes on the deferred portion. Therefore, the so-called tax-free rollover may be more appropriately referred to as a tax-deferred rollover, but it still presents a favorable option. The appropriate amount of rolled equity and the corresponding tax treatment are important topics to think through early in the transaction process so that the legal structure can be planned accordingly. Reach out to Montage Partners with any questions and explore our website for more topics related to selling your business.